Dominic Konstam with us at Deutsche Bank. He joins us by telephone in his busy day at Deutsche Bank. Dominic, I want to bring up one of your research notes right now, and this is the Konstam of old. You were way out in front with David Rosenberg on disinflation and yields. Near-term low point to 2.75%. We see the risk of a sustained period of yields below 3%. This is less because of the risk-off trade and more because of the liquidity trade. What do you mean by that, the liquidity trade?
Well, basically, the economy is obviously not doing well, and we're finishing QE2, and the issue for the Fed is to basically keep as much liquidity in the system as possible and talk very dovishly. So we think there's going to be a lot of supporting noises coming out of the Fed that can be thought of as a liquidity trade, which has to be there to support risk assets. Doesn't mean risk assets are going to do particularly well, but it means at least that they hopefully will not go back down to where they were prior to the start of QE2.
And you see a headline there, folks, as a governor of the bank, Tarullo, talking about bank mergers. He would oppose those at increased risk. A continued debate in Washington. Dominic, off of the jobs report today, is it persistent or is this a one-off? What do you and your team of economists suggest?
Well, it's persistent in the sense that the most important thing is that the recovery that we're having is subpar. I mean, we're struggling to grow more strongly than potential growth. Potential growth is nearer 2%, and if we can only grow at 2 to 3%, that is, I mean, for some people that may sound all right, but it's an absolute disaster in the context of the fiscal tightening that needs to take place. So if we're going to get any kind of fiscal tightening, then the risk is you'll have a recession if all you can do is grow around 2 or 3% without the fiscal tightening.
Okay, we talked about this, Dominic, with Ethan Harris earlier. Bring up too much information. And Dominic, Ethan framed this as a positive 1% surplus effect, down to 0%, and now down to a negative 1%. Folks, here is government spending back, way back to 1990. And you can see it moving up there. And notice how it's rolling over right now. How much will this take off GDP, Dominic?
Well, right now, I mean, we're thinking that next year we're going to slice at least 2% off GDP. That includes the unwind of the stimulus from the Obama package late last year, plus some other unwinds from earlier stimulus. And that's before Congress or the president agrees to anything in addition. So it's going to be at least a couple of percent potentially, which obviously gets you to zero if your underlying growth is only about 2%.
That seems politically impossible. In your study of political economics, have we seen a time where politicians don't react to that reality of 0% growth? That they're going to have to provide some aid, aren't they?
Well, this then gets you back to this liquidity story, because I agree. I think it's very unlikely that anyone's going to sign up to fiscal tightening if it's going to tip the economy into recession, which means we have to delay the fiscal tightening. And then that gets you into the S&P, Moody's sort of potential downgrade situation. It gets you into the concerns about the foreign investors. Our current account deficit is narrower, but it's still around 3%, and foreigners obviously are a little bit itchy in terms of financing it. They want to see the government deficit come in, and if they start to back off, then you have the question of, do we have a worse possible world where the real growth isn't there, the Fed is at zero, the long end is selling off, equities are doing badly, you have a sort of classic kind of dollar crisis, and that could anyway lead to recession if you're not careful. So those are the kind of challenges ahead of us if we can't get stronger growth in the first place.
Bring up chart 5, if you would, Roxanne, please. This is an important chart, folks. We've shown this a little bit. The rare event of a negative 10-year inflation-adjusted yield. This is way out. Most people look at real yields in the 2-year space, maybe 5-year. Dominic, here's a 10-year yield, and we are just plunging down, as we've seen so few times going back 60 years. What does it signal to you to see this gross accommodation?
Well, it is part and parcel of this liquidity story. I mean, I think I sort of agree with the general idea that 10-year yields won't sort of post represent a very good value to real investors, because you could look back and say, my God, inflation was that much higher than I was being compensated for. But the trouble is that there are a lot of things that policymakers can do that we could easily, for example, tip ourselves back into deflation if in the end we did say go down a fiscal tightening road, or if in the end the Fed did decide to raise rates because they didn't like the inflation that they're seeing now. So although the right thing to do is to basically have very low real yields now to generate lots of liquidity and try and deliver the kind of inflation that will make the economy better off in the future, and that's kind of what's going on. There's a sort of almost a game theory going on between investors and the policymakers.
I exactly agree with that. I was just going through my head this idea of the game theory that's out there now. What should be the game theory of savers? Dominic, you work in the ether of institutional Wall Street. What should the basic saver do out there now, given where yields are and given the persistency of low yields you see?
Well, I think it's going to take a little while for the policymakers to come to the conclusion that they can't afford to tighten fiscal policy as much as they would like, and bearing in mind that we already have embedded some fiscal policy. So that means that yields are probably going to keep falling. 10 years, could easily go to 2 3/4, possibly to go to 2.5. We have fair value models that suggest if the funds rate's at 0 right the way through into next year and beyond, and the 2-year note is going to be very low as well, then 10 years can easily trade around the 2.5%. And that would probably be with a sort of a mild risk-off trade in terms of wider spreads and also weaker equities. But I think then investors have to be very careful, because if it is the case that we don't do the fiscal tightening, if it is the case that the dollar weakens further and the foreign investors get a little bit nervous, then we could easily take 10s back up again. So this isn't going to be a kind of let's buy a 10-year note and fall asleep for the next 10 years. It's going to be buying a 10-year note and watching it for the next few months, and then maybe expecting it to back up again if we get any disappointment on the fiscal thing. And then really the third sort of round of this is what the Fed does, because I think the Fed isn't done on quantitative easing. Right. The Fed will come back and they will stop the 10-year yield rising as much as it might do, and that will be very interesting. And that's the truly liquidity story, where we end up having the banks finance the current account deficit.
Dominic Konstam, thank you so much from the Deutsche Bank desk this jobs day. And you heard there, folks, he talks about a target of 2.5%, although he's published 2 3/4.